Imagine an economy so large, so dominant, and so seemingly permanent that its citizens genuinely believed collapse was impossible, right up until the exact moment it happened, not once, but 4 separate times, in 4 completely different decades: 1929, the 1970s, 2008, and now. Each time the warning signs were sitting in plain sight for years before the crisis hit. They were buried in debt charts, inflation reports, and banking data that almost nobody outside Wall Street bothered to read. Right now, in 2026, the Congressional Budget Office projects a dangerous path. Federal debt held by the American public is expected to climb from roughly 101% of GDP this year. By 2036, it is projected to reach 120% of GDP. That would be higher than anything America has ever recorded, even after World War II. And right now, quietly, ordinary households across the country are showing stress. Nearly 5% of all outstanding consumer debt sits delinquent. Credit card delinquency rates have reached levels not seen since the depths of the 2008 financial crisis. History does not repeat itself in exact detail, but it rhymes loudly, in the exact same places, again and again. This is the story of how 4 American economic collapses actually happened, what they all secretly have in common, and whether the warning lights flashing across the U.S. economy right now mean history is rhyming one more time. Welcome to Economy Rewind History. This is the pattern behind every American collapse, and the uncomfortable question of where we stand inside that pattern today. Let's begin with the collapse that still defines how Americans imagine economic disaster. 1929. The decade leading up to it was called the Roaring Twenties, and it was built on a fantasy of endless, effortless prosperity. Stock prices climbed almost every single year throughout the 1920s, often disconnected from whether the underlying companies were actually growing profits to justify those valuations. Ordinary Americans poured their life savings into the market. Cab drivers, shopkeepers, school teachers, and people who had never owned a single share of stock before. They were convinced prices could only move in one direction. Much of this buying was not even happening with real money. Investors were purchasing stock on margin. They put down as little as 10% of the actual price and borrowed the rest. That meant for every real dollar an investor had, they controlled $10 of stock. As long as prices kept rising, everyone looked brilliant. The entire system ran almost purely on collective confidence and borrowed money, a combination that works beautifully right up until the moment it does not. On October 29th, 1929, that confidence shattered completely. History remembers that day as Black Tuesday. Over 16 million shares were dumped in a single day, and roughly $30 billion in market value disappeared within 4 brutal trading days. Adjusted into today's economy, that would represent trillions of dollars vanishing in less than a week. But the crash itself was not what caused the Great Depression. What turned a bad week on Wall Street into a decade of global catastrophe was the banking system underneath it. There was no government insurance protecting ordinary deposits. So when depositors panicked, they rushed to pull their money out all at once. Banks collapsed by the thousands. Over 9,000 banks failed across the country, and they wiped out the life savings of families who had never touched a single stock. Unemployment eventually reached 25%. 1 out of every 4 American workers who wanted a job could not find one. The lesson buried inside 1929 is this: speculation and leverage inflate a bubble. But the banking system determines how far the damage spreads. It is the actual plumbing connecting your paycheck to your savings. And when that plumbing breaks, a market correction does not stay contained. It metastasizes into a full societal collapse. Jump forward 4 decades. The crisis that struck America in the 1970s looked almost nothing like 1929 on the surface, but underneath, it was built from strikingly similar ingredients. Government spending was running far ahead of what the economy could actually sustain, and the gap between promises and reality kept growing. Throughout the 1960s, the U.S. government dramatically expanded spending. It funded the Vietnam War, and it funded a massive expansion of domestic social programs. But it did not raise taxes enough to fully cover either. This created chronic budget deficits. And the government increasingly managed those deficits not by cutting spending, but by allowing the money supply to expand. In 1971, President Nixon made a decision that reshaped the global financial system. He ended the direct convertibility of the U.S. dollar into gold. This policy became known as the Nixon shock. For the first time in the modern era, the dollar was cut loose from any fixed physical anchor. Then, in October of 1973, another shock hit. The Organization of Arab Petroleum Exporting Countries imposed an oil embargo against the United States. It came in retaliation for American support of Israel during the Yom Kippur War. Oil prices quadrupled almost overnight. For an economy utterly dependent on cheap oil, this was catastrophic. Cheap oil ran factories, heated homes, and fueled American cars. Suddenly, that foundation cracked, Gas lines stretched for blocks. Prices for basic goods soared. And the 1970s produced something genuinely new in American economic history: stagflation, a punishing combination of high unemployment and high inflation happening at the same time. Mainstream economic theory at the time insisted this was essentially impossible. Inflation was supposed to happen during periods of strong economic growth. But now America had inflation and economic weakness together. By 1979, inflation was running above 13% annually. The Federal Reserve eventually had to respond with extraordinary force. Under Chairman Paul Volcker, interest rates were raised to a staggering 20%. The goal was to break the inflationary spiral. It worked, but the cure was painful. Those high rates triggered a severe recession in their own right, but they ultimately restored confidence in the dollar. The lesson buried inside the 1970s is this: currency and confidence are inseparable. Once ordinary people stop trusting that their money will hold its value, everything changes, and the cure for lost trust is often as painful as the original disease. Now let's move forward to 2008, a crisis that looked completely different from both 1929 and the 1970s. It was not built on stock speculation, and it was not built on oil shocks. It was built on housing, mortgages, and an almost willful blindness inside the banking system itself. Throughout the early 2000s, interest rates were historically low. This followed the dot-com crash and the September 11th attacks. In that environment, American banks began issuing mortgages with increasingly little scrutiny. They gave loans to homebuyers who often could not actually afford to repay them. This category of lending became known as subprime mortgages. Wall Street then took these risky loans and packaged thousands of them together. They turned them into complex financial products called mortgage-backed securities. These securities were sold to investors around the world, often with credit ratings that dramatically understated how risky they truly were. Housing prices climbed relentlessly for years, and as long as prices kept rising, the entire system appeared to work. Even borrowers who could not afford their mortgage payments had an escape. They could refinance or sell their home for a profit. This was the same psychological trap that inflated the stock bubble of 1929. Only now, it wore a different disguise. An asset price seemed to only go up. That fueled borrowing, that fueled speculation, and the whole system only made sense as long as prices kept climbing. When housing prices began falling in 2006 and 2007, the structure started breaking. Everything built on top of those prices began collapsing. Major financial institutions had bet enormous sums on mortgage-backed securities. Suddenly, they were holding assets worth a fraction of what they had paid. Then came September 2008. Lehman Brothers collapsed into bankruptcy. It was one of the oldest and most respected investment banks on Wall Street. Its collapse triggered a full-blown global financial panic. Credit markets froze almost entirely. Even healthy businesses suddenly struggled to access short-term loans they needed just to make payroll. The U.S. government and Federal Reserve responded with unprecedented interventions. One of them was the Troubled Asset Relief Program, known as TARP. It authorized roughly $700 billion to stabilize the banking system. Emergency actions also rescued some of the largest financial institutions in the country. Those decisions remain fiercely debated to this day, because millions of ordinary homeowners lost their houses to foreclosure, while the banks that helped cause the crisis were bailed out, at least in the eyes of many Americans. The lesson buried inside 2008 is this: when financial institutions become extremely large and deeply interconnected, their failure threatens everyone. Economists call this too big to fail, and once that happens, the government faces an impossible choice: rescue institutions that arguably do not deserve it, or risk a collapse that punishes millions of innocent people even more severely. So now we arrive at today, in 2026. And the honest, uncomfortable question this entire documentary has been building toward is simple. Does the current U.S. economy show the same warning patterns? The same patterns that preceded 1929, the 1970s, and 2008? Let's walk through the evidence carefully, because the answer is more complicated than blind optimism, and more complicated than panicked doom. On the government debt side, the picture is stark. The Congressional Budget Office's most recent projections show federal debt held by the public rising sharply, from roughly 101% of GDP in 2026 to 120% of GDP by 2036. That level would exceed the previous all-time high, a high of 106% of GDP, set right after World War II. Net interest payments on that debt are also projected to more than double. Think of this as the government's own credit card bill. It is projected to climb from just over $1 trillion in 2026 to roughly $2.1 trillion annually by 2036. That would make interest one of the fastest growing categories in the entire federal budget, competing directly with military spending and with Social Security and Medicare, all fighting for the government's available resources. This mirrors an old structural pattern, not in exact numbers, but in basic shape. It resembles the dynamic that plagued Rome's economy centuries earlier, and the same dynamic that fueled American deficits throughout the 1960s and 1970s. A growing gap between what the government has promised to spend and what it actually collects in revenue, increasingly financed through borrowing rather than difficult political choices. Meanwhile, on the household side, the pressure is becoming harder to ignore. This is where ordinary Americans actually live their financial lives day to day. The New York Federal Reserve's most recent household debt and credit report covers the first quarter of 2026. It shows total household debt reaching a record $18.8 trillion. And roughly 4.8% of all outstanding household debt sits in some stage of delinquency. Look closer, and the picture becomes even more concerning. Credit card delinquency rates have climbed to levels not seen in 16 years, levels last observed at the height of the 2008 financial crisis. Auto loan delinquencies have reached the highest levels the New York Fed has ever recorded, at least in the history of tracking this specific data. Student loan delinquencies have also surged. They have reached their worst levels since before the pandemic-era payment pause began. Researchers at the New York Fed have pointed to signs of a K-shaped economy. That means higher-income households remain financially stable, while lower-income households show genuine and mounting financial strain. They are falling behind on multiple types of debt at the same time. Credit cards, auto loans, student loans, and everyday bills, all while prices for essentials continue climbing faster than their wages. There is also a newer pressure sitting on top of all of this, one that has not been historically tested in the same way. Growing concern around massive investment in artificial intelligence infrastructure. Some economists and market analysts are asking a difficult question. Is this a genuinely transformative economic shift? Or do parts of it carry the speculative characteristics of previous bubbles? Enormous capital is flowing into one technology sector. But for many specific applications, the eventual profitability remains uncertain. That structure feels reminiscent of the dot-com boom of the late 1990s, not necessarily in outcome, but in pattern. This is not a prediction that AI investment is destined to collapse like housing did in 2008. That would be too simple. It is an acknowledgement of a recurring historical warning. Whenever enormous amounts of capital rapidly flow into a single sector, economists pay attention, especially when that investment depends heavily on future expectations, rather than current, proven profitability. Historically literate economists watch those sectors closely, because similar conditions have appeared before major corrections in the past. So here are the genuine structural similarities connecting all four eras. This is the pattern the entire documentary has been building toward. In every single case, the crisis did not come from nowhere. 1929, the 1970s, 2008, and the pressures visible today all share that truth. The danger came from a slow accumulation of imbalances, too much borrowed money, too much confidence, and too many assumptions that the future would keep moving in one direction. In 1929, the asset was stocks. In the 1970s, it was oil-dependent industrial capacity and a strained currency system. In the 2000s, it was housing. And today, the warning signs appear across debt, households, government finances, and speculative investment. Each era had its own trigger, but the deeper pattern was similar. Financial institutions and government policy kept extending the cycle. They enabled the borrowing. Sometimes they encouraged it. And they kept doing so right up until reality reasserted itself. In every case, the warning signs were visible years before the crisis hit. They were visible in economic data, visible in debt levels, visible in prices, visible in institutional behavior, but most participants dismissed them because they were convinced that this time things really were different. And in every case, when the correction finally arrived, the damage was not evenly shared. It disproportionately punished ordinary people, depositors, homeowners, workers, and families, people with far less power to protect themselves, far less power than the institutions and speculators whose decisions created the imbalance in the first place. Now let's talk about what is genuinely different today, because a fair and balanced accounting requires more than warning signs. It also requires acknowledging the safeguards that now exist, safeguards that did not exist during previous crises. Unlike 1929, ordinary Americans today have federal deposit insurance. Their bank deposits are protected through the FDIC. That means a banking panic can still be economically damaging, but it cannot wipe out ordinary families' savings in the same way. Not the way bank failures did during the Great Depression. Unlike the 1970s, the Federal Reserve today has decades of accumulated experience. It has spent generations studying how to manage inflation and how to preserve monetary credibility. That does not make the Fed perfect, but it does mean today's policymakers have more sophisticated tools. Tools designed to fight inflation without necessarily repeating the prolonged stagflation of the 1970s. Unlike 2008, the banking system is also more heavily regulated. Post-crisis reforms required banks to hold larger capital reserves. Those requirements were designed for one purpose: to make the banking system more resilient. especially against cascading, interconnected failure, the kind of failure that nearly collapsed the global financial system less than 2 decades ago. These safeguards matter. They are not empty reassurance. They are genuine, hard-won lessons from previous collapses, but they do not eliminate risk entirely. They only change how risk travels through the system. But here's the honest, uncomfortable tension sitting underneath all of that reassurance. Safeguards designed to prevent the last crisis do not always prevent the next one. They are usually built to stop the exact mechanics that failed before, but a new crisis can emerge through a completely different channel. And every era we examined tonight believed its own foundations were more sophisticated, more advanced, and more resilient than the generation before it. The bankers of the 1920s believed the market had entered a permanent new era of prosperity. The economists of the 1960s largely believed inflation and unemployment could not rise together. The financial engineers of the 2000s believed they had diversified away mortgage risk. They believed complex securities had made the system safer. But confidence in current safeguards can become its own danger. It becomes psychological comfort. And that same comfort has appeared before every previous collapse in this story. So let's return to the question this entire documentary has been building toward. Is America collapsing? Or is it simply entering another painful, historically familiar economic reset? The honest answer resists both panic and complacency. The current data shows genuine and measurable structural stress. The debt trajectory is serious. The Congressional Budget Office itself describes it as unsustainable under current law. Household delinquency rates are climbing toward levels last seen during an actual financial crisis. But as of today, the data does not show one thing. It does not show the kind of acute banking failure that defined 1929. And it does not show the kind of cascading financial collapse that defined 2008. It also does not show the runaway double-digit inflation that defined the 1970s. What it resembles most closely is the quiet pressure before a crisis, the accumulating pressure that existed before each of those eruptions, the period when the data was already flashing warning signs, but the visible dramatic collapse had not happened yet, and most people were still living normally, understandably assuming tomorrow would look basically like today. History's real lesson across all 4 eras is not that collapse is inevitable. It is not that collapse is imminent. And it is not that collapse is always avoidable through clever policy. The real lesson is that American economic collapse has never arrived from nowhere. It has never struck suddenly out of a clear blue sky. It arrives slowly, through years of accumulating debt, speculation, and eroding trust. Then, when the imbalance becomes too large to sustain, it arrives all at once, in a matter of days or weeks, catching a population that had spent years hearing the same promise, that this time really was different. Whether today's warning signs turn into a genuine crisis is not yet decided. The debt trajectory, the household delinquency data, the questions around AI investment, all of them could resolve into something painful but manageable, or they could become something larger. That depends on choices that have not been made yet, choices by policymakers, choices by financial institutions, and choices by the American public. But if history is any guide, this generation has one advantage, an advantage previous generations did not fully have. The actual data is visible, the actual pattern is visible, and the warnings are sitting in plain sight, right now. For anyone willing to look at them honestly, if this story changed the way you think about debt, collapse, and hidden warning signs, subscribe to Economy Rewind History, because the pattern has repeated itself 3 times already. The only question left is whether this generation is watching closely enough to see it coming a 4th time.